Higher for longer. The market is finally starting to get it. The higher for longer scenario literally means higher interest rates for a longer time. Let's talk about it. Welcome back, everybody. Don and Tom back with another market preview from MarketBeat. Welcome back to the channel, Thomas. I've been off a few weeks. Things are looking much the way they were when I left. And you said in your newsletter this week, you started it off, and I want to start off with this. You said the market is finally starting to get it. Explain to us what you mean by that, and then we can go from there.
Well, that theme of higher for longer has been kicked around the market for at least the last year, and I think up until the last week or so, everybody thought that higher for longer didn't really mean what it really means, which is we're going to have high rates for a long time. The way that inflation is going right now and the underlying momentum in the economy, there's just no reason to think that inflation is going to come down to the Fed's target rate within the next year or two, and interest rates will stay above average for at least that long. So as far as coming to terms with what's happening, I think the market has finally realized that the new normal is now just what normal is.
And you know what? Maybe we stop calling it the new normal, just call it normal from this point forward. You and I have talked about this at length for the past year or more about a new normal sort of being implemented, if you would. Maybe we are, or just this is just the way it's going to be right now. We asked a question, Thomas, this week on our YouTube channel. I hope the viewers got a chance to take a look at it, about stocks being so down in September. Everybody's selling off in September. Would they be hopeful in October? Or would they be buying stocks back in October? And the percentage of people was really high that don't want anything to do with stocks right now. 75% of the responding people said no, they're not buying stocks, and they think the market would go even lower. What's your take on that as far as the market going lower? Where are you at on that?
I think the market has topped out. I think that we're confirming resistance at key levels right now. I think that we've got a good 3 to 11% more to fall, which would put the market about 20% down from its peak. So I fully agree with that sentiment that October does not look like a great month to be buying a lot of stocks.
We had jobs report come out this morning. Everybody waits on that every first Friday of every month. The job number was hot. Market went down. As we're talking right now, the market is still down on this Friday, probably going to be down for the week. Tell us how the job numbers and the interest rates work together, and what the responsibilities, the mandate, if you would, of what the Fed does and how they're going to handle this situation. Because we still have jobs. We're still adding a lot of jobs.
Totally. You're talking about the Fed's dual mandate of maintaining employment and maintaining stable market conditions, interest rates. Those two things don't really go hand in hand. Like what I said in the newsletter is, you think about a soft landing. I mean, we're in a soft landing right now. And what that means is that labor markets are still hot. Inflation is still being driven by wage inflation and labor market driven consumption. The Fed has no choice but to continue raising interest rates. They can't back off of their policy because labor markets will remain strong. As long as wage inflation remains strong, inflation is going to remain strong. So from that perspective, really, the Fed needs to hurt the labor market to fix inflation. And I think that is what the market is becoming to realize, and that a recession isn't really like, possibility. It's like a necessity.
I want you to speak to the people. Chris is one of our contributors at MarketBeat and comes on with videos with you and Lacey all the time. But he said we had a recession already. I happen to agree with him, unless you want to change the technical definition of what a recession is and how we defined it for, I don't know, 40 years or so. And the new definition, did you think we were in one, and would we be headed back for what Chris likes to call a kind of a double dip recession?
Well, right. So we were talking with Chris about this, so I know where your question is coming from, and I fully agree with Chris. Last year we had a recession. We had 2 quarters of negative GDP growth. Along with that, we've had almost 2 years of negative leading indicators. retail sales are kind of positive, but they're being offset by a reduction in consumption and volume demand, being offset by inflation. So I think that we're absolutely heading for a double dip. And as Chris was saying before, the double dip, the second dip is usually worse than the first.
On a editorial note here, and maybe this is a little bit personal, but do you feel like we're in a soft landing? Because I don't. As a consumer, I do not.
Well, I mean, I would say technically we're in a soft landing because we think the Fed has got inflation coming down, but and employment is still pretty hot. But I think what we're doing is we're easing into a hard landing more so than having a soft landing. So like right now it's kind of soft, but I think we're heading for a crash landing because the Fed will have to hurt the labor market in order to contain inflation.
So rather than ease the Band-Aid off, as we have been doing, we're going to get to a place where we just rip it off.
I mean, either that or we're going to reach a tipping point in which the market just crashes on its own because there's only so much pain that it can take. But
All
talking
right,
about ripping
go
up a
ahead.
Band-Aid, I mean, what I think about the Fed and where it's been this whole time. They've been behind the ball the whole time. They're still behind the ball. If they want to get this thing fixed, they need to do something to fix demand and consumption. And so far, they haven't done it.
All right, we got big earnings starting up again. Let's get off of the Fed for a little bit. We beat them up enough, and we do tend to do that quite a bit. Well, frankly, they have it coming. But let's go to
An easy target.
earnings reports that are coming out this week. We got big earnings seasons coming. Everybody's happy during earnings season. They get to read about their stocks. They get to see what their stocks are doing. First one I want to talk about coming this week is one that I know you love. PepsiCo. The trend line on PepsiCo is up, 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 although the prices recently have pulled back to that trend line. What are you expecting there? What do you expect to see? And our PepsiCo shareholders going to be happy come Tuesday morning?
I think that they will be happy come Tuesday morning. So Pepsi stock has corrected about 20% in the last 2 months. That's pretty huge. That's driven by fears of slowing demand, fears of consumers shifting down to cheaper products. But what's happened is that the analysts have lowered their estimates. The bar is set really low. We're still looking for growth. There is a high possibility for outperformance in a company that's still growing and is a healthy dividend payer. Pepsi's trading at the lowest P&E in years while also paying the highest yield in years. So I don't think that it will take very much for a bottom to get put into place. If we get a solid report, we may see a pretty vigorous rebound.
Banks are coming up starting, I guess it's Thursday of this week, if I read that correctly in your newsletter. Delta's coming this week. Domino's Pizza's coming this week. Speak to those if you would for a little bit. What can we expect out of those? Let's go with Delta first. This is one that we did a video on previously. We liked Delta back when we did the video based on the fact that they were selling more premium seats, upping that revenue. But now we've got fuel costs involved, and Delta could, go down right now based on just the cost of fuel.
Right.
What do you got on that?
So Delta also corrected pretty severely since we did that video. And that's because right after we published the video, oil prices started to spike. And soon after that, Delta warned about margins. So now in the report, we're looking for another solid gain in revenue and a gain in earnings as well. But the question is, how has oil cut into margins and what's the outlook? It's possible that Delta will outperform and reinvigorate the market, but it's equally possible that rising inflation and margin pressure will keep the stock down.
You're going to write about Domino's this week. At least that's what you put in your submissions to write about this week. Is Domino's something that people follow, widely follow to get a gauge on what's going on inside the markets?
Yeah, I don't know about that, but Domino's is a pretty healthy food company. They're still growing. They have good margins. It pays a pretty sizable dividend. But right now, the concern with that one is these new diet drugs like Wegovy. It's possible. I think there's some evidence that eating habits are shifting, and it's possible that fast food like Domino's could suffer for it.
Which big bank are you going to look for first? Which one is going to be your bellwether? So, okay, here we go. This is the one
Well,
I've been waiting for.
Well, that's easy. JP Morgan is the only bank to watch. I mean, it's the biggest bank in the world. They've got business segments that cover every aspect of banking. So you just need to look and see how they did to know how the banking sector is going to do. But expected to do really well year over year because of high interest rates. Business might be flattish sequentially, so the bar could be set low. And this one, with the banks, we're looking to see consumer health. How is consumer credit holding up, delinquencies and charge-offs, and how are capital reserve builds cutting into earnings?
All the talk and all the news of smaller banks failing and whatnot has kind of died down a little bit. It'd be interesting to see what we get out of earnings in the next couple of weeks concerning those. But there's one thing I want to talk about before we leave, Thomas. That's the VIX. We're going to do a video on that. You and Lacey will do a video on that later about what the VIX is, how it affects markets. But this week it rose to a 5-week high. And I think that's something that we need to talk about and perhaps explain a little bit about what you're seeing there.
Well, yeah, so the VIX is the market's fear gauge. What it really is a measure of the price of options relative to the S&P 500. So when the price of options rise, the VIX will rise. The rise of options is used as a proxy for fear because when you get more fearful of a stock falling, you're going to want more money for your options. So over the last couple of weeks, the VIX has put in a bottom. And it looks like a pretty firm bottom. It's possible that we could get a nice rebound in the VIX, which would equate to a sell-off in the S&P 500. But even if we don't get that, it looks like volatility is going to stabilize, normalize above pre-pandemic levels and keep volatility in the picture, at least for the next quarter.
Thomas, thanks for being with us today. Great insight as always. Folks, down below, if you would, leave us a comment. If you want to continue to see Thomas on these kinds of videos, we'd appreciate some input there. Give us a yay, give us a nay. Nobody gets in trouble over that. Just let us know how you're feeling. If you'd like to read Thomas's newsletter on a weekly basis, all you need to do is go to marketbeat.com, enter your email, and you'll get that newsletter free of charge every Sunday afternoon, I believe it is, around 4 p.m. Give you an outlook.